Okay. This is the second part of the free cash flow to equity model sort of discussion. I just finished editing. Editing is a stretch, but the first part, and it came out is about as good as you could ask for. So continuing with our model discussion on interdigital, there's two things that we wanted to mention before potentially taking a look at another example or building out our own company or a company that's not associated with the ramp fund, just to show you what that looks like. The first thing we'll discuss is this change in working capital metric. And let me take a look at Bloomberg here. So the problem with, the change in working capital. So the problem with change in working capital is it's really difficult to estimate, right? Because for any length of time, right? So, one other thing I failed to mention is that if you leave this opening spot blank, it will take the data from the last year and just extrapolate on that for all of the columns. Anyway, and here's why, right? So if you can see back here, remember, change in working capital is the difference between, the difference between current assets and current liabilities. And this is taking the change of it from year over year. Right, and the difficulty with estimating it is, and interdigital is a perfect example of this, right? There's years where it's seriously impacting their free cash flow or seriously benefiting it, right? For whatever reason. And on a long enough timeline, right, like this is really difficult to sort of figure out. And you can figure it out for a year. Like, let's take a look and see if we can figure out what interdigital site could potentially look like for the year. That'll be in balance sheet. Yeah, so they don't even have any, like there's no estimates out there. We can double check model to see if there's any information about it there. Sometimes they, like the financial ones have some model information, but typically you're going to find like the real stuff in from like experts and other analysts in the MODL screen. So here's a condensed balance sheet. Okay, so this year it looks like they're going to be 1,200, and then let's see, 728. So they cut down on their liabilities quite a bit by about 150 or so, and then they added about 100 flat. So their change this year is actually going to be like quite large, which is going to have an impact on the model, obviously. So because last year it's 250 more total because you're subtracting out the current liabilities. It's going to be 250 more working capital to work with than the prior years, right? But the problem with that is that that's impossible to do like forever, obviously. And at some point it's going to flip back where you're going to have more liabilities than assets. And in fact, with interdigital's numbers, they could only do about 3 years of this before they just don't have any current liabilities at all. So that's not really realistic either, right? What I've found works is you could take the 5-year average in this case, right? Because that's about even, and I think they want it to be about even over a long enough timeline. But that's not really that accurate either because they have this big 250 number coming out this year. Excuse me, what did I just do? Okay, there we go. And the same sort of logic applies to net borrowings with this cell as it does up here. Whereas like if you can't, this is not realistic. Whereas like the net income increasing 5% year over year is realistic, so this number can stay there. Same with depreciation increasing 3%. Change in working capital being this high, like that's not realistic at all. And you can see that now the model's projecting a 49% downside for this company, right? So for this model, I'm going to think that because there's not that much coverage here, and we have to assume that at some point in the future it's going to come back, like the 5-year average is actually somewhat reasonable here. Although you could honestly even do like a sort of something like this because we saw that for the following year. Let's bring up this chart again. The estimates are saying that they're going to have about the same level of current assets, but they're going to get rid of even more of their current liabilities by about, what is that number? 185 or so. And like, you can have all sorts of thoughts on whether or not you think this is accurate or if this is like something that should be explored, or if you can justify, or maybe they're going to actually pay off even more, right? Like 100. Okay. And the trickiest bit for a company like InterDigital is, they have relatively consistent numbers everywhere else. They only have this debt payment. They have the same capital expenditure, but it's this working capital number that's really all over the place, right? And this varies regarding which companies you're actually going to be dealing with, like substantially. I would say it's one of probably the most, I think it might be the most difficult part about interacting with this model is just making sure you have a handle on it. But at the end of the day, right, like, does it really mean that much is another question, because, change in working capital is an interesting statistic because it's suggesting that, the capital and why it's negative in terms of free cash flow isn't being like deployed, so to speak, correctly. Because, okay, maybe the assets go up or the assets stay the same, or even the assets or current assets like go down. But as long as the liabilities exceed that metric, that's where the actual sort of change year over year is, right? And we see that. And yeah, so like, I don't know, if you put a 12 here, is it realistic? Maybe. I mean, honestly, considering everything else we've seen so far, even if we attach a 48 to it, like, you're still getting a 6% upside on a company that is growing quite rapidly. I mean, they've had unbelievable growth back here. And this is kind of in line with where our projected growth statistics were for InterDigital. I think at the time when we were running it for the year, I think we settled on a number of around, I don't know, like 180 per share. But now we have more info about what their net income is doing, and everything else that's in line here suggests that, this could genuinely be accurate. Okay, but yeah, so do some research on how you want to potentially work on this effectively. I don't mind the first year, obviously, doing it. Even the second year sometimes, but anything more than that, and it's like, I mean, you could have like a 400 here randomly from, I don't know, maybe they sell something, or even buy something from another company that happens all in the same year, where it's like all of a sudden, we have these additional liabilities now, and we go back to 48 here, and it's like, okay, now we're 100 for the year, right? It's making some impact. The key thing, though, is just make sure you have a relatively reasonable number here that's not seriously distorting the future, right? Because if you have a negative 100 out here, it's like, all right, all of a sudden now it's plus 39%. And that could be true for that year, right? Like, that could be extremely true. The issue is just like, that's when you attach it to the perpetuity, and if you actually look at the equation of what's happening here, right? Like, the final state value is enormous because of that. So, okay. So for the sake, we won't get too deep into the woods on it right now. I will say that we'll take the 2-year average, or we'll take the last year that they had this, we'll extend this out, and then we'll discuss further about terminal growth rate. Okay, so the terminal growth rate has kind of an enormous impact on the terminal stage value, right? In fact, it's probably, besides in some cases change in working capital, the most impactful variable on here, and beta. Any beta above like 1.6 starts to have a pretty huge impact. But let's say, for sake of argument here, that InterDigital is a fast-growing, effective tech company, right? So on the face of it, you could reasonably argue that 3.5% is a solid terminal growth rate. And look what that does to the model, 23% upside, right? And then you can get even deeper in the woods and be like, well, let's say that, they established all their patent portfolios, or, for whatever reason, why is it there now? There we go. For whatever reason, their growth slows further, or it's not going to grow as fast. You can put in a 3.0, and you start to see in the sensitivity like some red start to creep in, and gives you a 14% upside. I think a 3% is reasonable for terminal growth rate. I think that a 3.5% you could easily justify for this company, right? But as we saw, like for some of the estimates, maybe they're just having a banner year and they go back to, say, 2023's numbers. 214, now you're showing downside, but then of course, undo that real quick. maybe they return with a higher. You see what I'm getting at here? Like, you can really tinker around with where like this model can accurately value like certain organizations, right? Because now look like what we've done here. Let's assume that they go back to 2023's numbers for whatever reason in 2025, and then they are going back to 2024's numbers approximately by the end of 2028. Is there any reason for this? No, it's just to show it off. I don't see any reason why that would happen. But then all of a sudden, it's like, okay, well, they've been growing at 15% for the last 4 years. Like a 3.5% is definitely more doable, even potentially for some companies, 3.75-ish. Anything more than 4, and you're going to start to run into a little bit of an issue with like justification of that. You have to be in a company that's like really, really, really has like some serious long-term growth potential. It's just the way the equation works. And now all of a sudden, like the company's fairly valued again, right? But going back to our original sort of estimate here, we find that we'll just leave this blank. Goes back up, 3% flat, reasonable working capital with inline depreciation, amortization, and about the same capex that they've been experiencing over the past 5 years, with them paying off, not taking out any more debt for 2027. We now come to a conclusion that InterDigital has a 14% upside in the stock market. Now, it's something to note here that the way you should view what the upside number means is not necessarily that it will reach it at some point. It should, but this isn't suggesting like a certain time period. It's not like, oh, in the next year or the next 6 months, in the next 3 weeks, whatever, that the upside of InterDigital is 14%, and it will reach that number at some point. And that's not what this model is suggesting. It's just saying that if these numbers that you're inputting into this model are correct, the company should be valued now at this price. And there's other market factors at play right now that are not interacting appropriately and sort of are like the market is not necessarily efficient on this company, right? Of course, you run into some other things where it's like you're never going to pitch a company that, well, I mean, you can, but you shouldn't. Pitch a company that is projected to have a downside, right, of any negative number, because that suggests that we should stay away from that company, in fact, short it. Anything around 0 to 5% suggests the company is fairly valued and there isn't that much upside in it. But InterDigital, after 100% run, yeah, I mean, this seems like a number that you could feasibly justify, for lack of a better term. So, yeah, that's about all that I wanted to talk about with InterDigital. Let's see if we can run through another quick example here and get this video sort of wrapped up on the free cash flow equity model. I don't know, what's a hot company right now? See, here's the thing. I don't want to make this too difficult myself, because sometimes if you have a lot of like variable net income numbers in the past, it does make it like slightly more difficult to look at. I'll do another one from the RAM fund. How about that? Not in my sector. I'll make it more fun. Let's do AdCore. So we just bought a lot more of AdCore, and I'm interested to see if I can reproduce the results that they were talking about. Okay. So now we've loaded up AdCore. We'll get the Bloomberg running while it's ATKR. AdCore is a manufacturer of construction equipment, in a sense. First things first, by the way, whenever you start a new model, got to get rid of all the old data. That one can stay, probably. Net borrowings we will remove. It's going to take the data from the last, whatever the last year was, right? So reset that. And of course, make sure you get rid of their beta too, because, well, now it's suggesting an absurd upside. We'll leave it at 1 for now. Okay, first things first. Let's go into AdCore's beta, historical beta, yada, yada, yada. Select the last year again. What's today? The 17th. Monthly updates 1.372. This is Bloomberg's estimate, by the way. If you go on like Yahoo Finance or something else, you may get some differing sort of results. Uh-oh. Do that. And make sure you clear out this data too. I forgot about that. Okay. All right, let's get started. So we're going to make this relatively easy on ourselves just to show what's happening here. So we'll go over to FA, see what's up over there. Go down the gap. Where's their net income? Net available common. Looks like they're estimated 250 for this year. Okay, 250 and then 280. I don't know what's up with that, but it's a pretty big decrease. Do 280 here. Too much. Okay. So now it's about in line with right now, just with the net income in. We have that going on. Looks like they've had some upscale depreciation for the last couple of years. You can also, this is something to add on. I'm not going to do it here just because I do want to fit this into the 30-minute sort of window that I have. But they will have, typically most companies will have information about the depreciation amortization in their 10K. Actually, I need to load it up for CapEx anyway, so we'll do that real quick. Why not? I think we have enough time. Oh, they just had a 10K. Nice. So that means this should actually be shifted forward. Yeah, see how the 2024 data is in now? So we're looking for 2025. And then see how over here it updates here. And in Petrosky, it should update as well. Yes. Now, this isn't the correct data, but if you have new data, it does update, which is nice. Oops. Okay. Where'd that go? Uh-oh. I'm not spelling depreciation correctly. There we go. Nope, oh geez, this is embarrassing. Oh, it's with a C. Okay. That was embarrassing, I'm sorry. Okay, no information about depreciation and or amortization. It's kind of strange, but wait a minute, did I spell this wrong too? Oh gee, everything's falling off the rails right now. Okay, not amortized. Adjusted EBITDA. Let's see. Typically, they'll have like a big section where they kind of talk about this a little more, something like this. That's not really relevant. Tangible asset amortization. Okay. At risk of spending too much time. Oh, here we go. So 121. They put that in. That's the past. They'll have notes about their future. Sometimes they don't. We'll assume for now that the rate that they're on is reasonable. So we'll start with, we can leave that for now. Okay, change in working capital. It seems like the company for the last couple of years has been pretty consistently changing their working capital in a positive way, which is sort of negative for the model. We'll take the 5-year average here because there are some wacko numbers kind of back here. Make that nice and simple for ourselves. CapEx, they got to have stuff about that. They're a construction company. So we'll tear through that again real quick. Where is it? Over here. Hopefully I spelled this correctly. Yay. Okay. Regulatory matters, capital, yada, yada, yada. No. Nope. That's about talking about some of their debt. We'll cover that in a little bit. Repurchase commitments, nothing about that. It's typically lower down in the statement when they're going to talk about the futures, if they have any projections on that. It looks like this company hasn't. Okay, so, the cost of construction has gone up pretty dramatically over the past couple of years, so I'm going to go out on a limb here and say that their elevated capital expenditure is probably going to stick around for a little bit. So we will leave this as is for now with the last year going forward. I don't think it's realistic to suggest at this point in time this company is going to go back to this time period, especially and the RAM fund just bought quite a bit more of it, so we were relatively bullish on it. Now, I don't have their model in front of me right now, but it's in one of our presentations, so more information about that can be derived if you want to see what they had to say, because I may be missing stuff. I'm only just looking at this company now. Check debt distribution. Now, for some companies, okay, revolving credit facility, loans due outside that range. They only got one coming up in 2028. That was about negative 350 or so. This goes back to negative 2. And the terminal growth rate of that. Okay. Now, of course, we have to, just on the face of it, right? Like, we're not going to do that much more research into it right now. This is not Atcore. Where is it? There we go. But typically the greens are revolving credit facilities, and I did see that number briefly in the 10K. This is outside their range. We can look into more information about what this actually is. This is a refinanced loan, secured tranche. What do we got for the... you always want to check to see what type of debt they're issuing to, like in general. For whatever reason, they just don't really like to put the info on here. Oh, wait a minute. This is something special because they don't show the coupon on the front of it. Okay, this is something else. So for the time being, we're actually not going to throw this in there because they could have a relatively reasonable chance of refinancing it and then just not paying this. Because remember, this model doesn't take into account interest expense. So we're going to leave that for now because that is some sort of special case circumstance. And you do get those a lot with the debt issuances, especially with companies who have had issues in recent times. It seems like right now we're suggesting that Atcore is going to only have a 1% upside, but obviously if you take a look at, they may be returning to strength in the future. So from here, like let's say for whatever reason that their growth rate's actually 10% instead of 5%, well, that now suddenly has quite a big positive impact, right? Even if you extend it over here, now it's all of a sudden suggesting a 22% upside. And for a company like this where they've had such poor share price performance over the last year or so, I mean, like, this has been a disaster for our holdings. We bought a lot more down here, which, I mean, they made the arguments. We voted on it, so I agree with that decision. The growth rates are probably relatively supercharged, especially when you start messing around with, like, the terminal growth rate, where it's like, okay, these guys are returning to form. They have very bullish tailwinds, and now it's 33% instead of 22%. I hope you guys are starting to, like, get the idea of what is actually happening here, right? And the key factor is, like, just do as much research as possible where, you know, you put in different numbers here and it has a huge impact on the model outlook. Like, let's say, I don't know, they go out of business or something. This year it's like, well, because it's 280s the next year, it's like, okay. But then it's also a 24% downside if they don't have, you know, this level of net income. Now, you could justify, honestly, that's probably even a better justification. We'll leave this for now. And this we'll draw our final conclusions off of that core here. So the key factors that you guys need to just be taking a deep look at is if they have debt payments, where and what are they? Making sure that we're not attaching absurd numbers that are in these two columns specifically that when added into perpetuity won't mess with the model, right? Making sure you're finding net income projections that aren't just from analysts, but are also from, you know, your own mind and your own conclusion about where the business is going, why there's certain tailwinds, if they're going to have higher, lower net income than the active running projections, et cetera. And then obviously for depreciation and capital expenditure and net borrowings in some cases to figure out like for example, revolving credit facilities are an interesting one. Or actually term loans would be a better example in this case. Sometimes they'll publish in there like, well, we took out all this money, and it clearly wasn't in the last couple of years because it was $350 million. But sometimes they'll say like, oh, well, look, like we only used this much of it. And when you refinance, it's like, well, you only are paying back not that much money at all. And then, the loan is just kind of existing in perpetuity, right? So, and that's more so for revolving credit facilities. Because if you suggest that, where is it? They're going to have to pay back this for Nexstar, for example, or for Atcor. We just looked at it. This loan exists, but they don't have to pay this back, right? Like they're probably not going to. It's pretty rare for a company that has and is on good terms with their revolving credit facility to give back the money. And they probably haven't taken that much out of it because it's, it's just a credit facility. If you need it, you need it, and then you pay it back. It goes back and forth, etc. So try to, the sort of concluding thought about this model and what I think the approach should be is just do as much research as possible and be able to justify every number on this list. If you think they're not going to borrow that much money, figure it out. If they have to pay stuff back, it should be there. If they are building a factory in 2026, for example, so their capital expenditure is going to be higher for that 1 year, make sure you tell people that that's going to happen, right? Change in working capital, you can draw your own conclusions on that because I honestly am not entirely sure. I mean, you could put pen to paper and be like, this is a reasonable estimate, but for stuff out here, it's very tough to do it. And depreciation, it's like they're going to have that information in the 10K most times. I guess Atcor doesn't, but most of them do. And finally, for the terminal growth rate, pick a number that is justifiable, for lack of a better term. A utilities company or a construction company like this one is, or industrials, probably shouldn't be above 3% on the face of it. And if it is, you're going to need to justify that. Or if it's lower than that, it's like, well, why are they, lower than the industry? Or utilities should probably not be above 2.5% or 2.75. Technology, it's like, okay, you can maybe justify, depending on which company you're looking at, a higher number. But, okay. At risk of taking up too much of your time, I'm usually in the trading room. At least I will be next semester. If you have any questions about this model at all, feel free to email me, dbotwinick@uri.edu. If I see the email, I'll be more than happy to answer any questions you have. And good luck, because once you get a handle on this, you can really start to get involved with companies that you're looking at in your sectors and make hopefully positive changes to the portfolio. So I appreciate you, if you made it this far, listening to my rantings and ravings about this model. And good luck. And I hope you enjoy learning how it all works and, all of the ramp fun, really. I think it's awesome. So thank you very much. And have a good day if you're listening to this.